Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, August 6, 2025. It's 10:17 a.m. Eastern Time, so we're starting the video. So what I'm going to do in this one, give you an update on the equity markets, hit on a few trade ideas, trade idea updates, new trade ideas, and try to get to any questions or highlight some of the questions and comments that I've replied to yesterday. Might even be some more today. We'll check there in a second. All right, this is QQQ, the NASDAQ 100 tracking ETF. You have the gap backfill with a slight overshoot. S&P also made a even more slight overshoot. So you had a couple objective short entries in the last week. You had the bearish engulfing candles from last week, both on the daily and weekly time frame. Those came on, the daily came on Thursday. Here, I'll show you. I'll recap stuff anyways. There's our bearish engulfing candle and trend line break. So dual sell signals in a single day. Very effective strategy with especially when you factor in the very low RR risk reward profile there. So that's what it looked like on the daily chart. And there's your bearish engulfing on the weekly, which, as I mentioned, coincided with that back test of the key uptrend line off the early 2022 lows. Early 2023 lows, January 2023, major trend line. And there's the rejection right there. So far, so good on that. And we look at SPY, the S&P 500, which also put in a bearish engulfing candlestick last week. Those are potential topping sticks where you need the body or the fat part of the candle to engulf at least the body of the previous one, and the more the better. And so on the daily, I think on QQQ, in the daily we engulfed the past 4 days when we put in that bearish on the daily chart. And then if you look at the track record, we've had quite a few in recent years, and they've all. None of them have proved to be the end of the super secular bull market that we're in, but most of those, I should say, have proved to be great sell signals for the biggest corrections, the most profitable corrections in bear markets to trade. So I'm just going to circle them here, and you can check them out on your own chart. There was the one we had last week. It's highlighted back here right before this drop. This was the biggest drop in years, one of the biggest drops in years. About a 22% drop in the S&P, even bigger on the NASDAQ 100. And as you can see, that was a nice, clean, bearish engulfing right there, highlighted at the time. And just like this one, there were other reasons to short back then that we had. Including but not limited to breaks of horizontal, uptrend lines, price support, and everything else. Then we took out the 200-day moving averages. So that really would be your next big, more powerful sell signal. A move down to and then ultimately below the 200, especially on a weekly closing basis, all the better. There was your first weekly close below the 200s. You back tested for the next couple weeks. And then when the market realized it wasn't just a brief overshoot, the bottom fell out. And I'm just going to go on here. So bearish engulfing, again, double-digit drop followed right there. Bearish engulfing, double-digit drop followed right there. That was even a bearish engulfing. So as you can see, you don't always have to have those, but as mentioned, the majority of the biggest drops, there's a bearish engulfing right at the highs there. And that was the bear market from 2020, early 2021, late 2021, early 2022 down into the 22 lows. So, and again, from my experience, I've been doing this a long time, the majority don't want to short when the market's at new highs. They don't want to short despite these sell signals we've had, and that's fine. You do you, I do me. I point out what are objective levels. But most importantly, again, the takeaway is the downside risk if stopped out is so small. And so if you had taken any of those, well, again, the majority, if not all of those were highlighted, they were all profitable trades. And more so, they were the bigger corrections. In other words, dip buyers. Dip buying works great. But what happens, dip buyers buy dips, and then when you get in these bigger corrections, they keep adding in, and they realize they're too heavy, they bought the dip, and then they start capitulating once they realize it's not working anymore. And so that's how these things unfold. So they start out a little slow, big bear markets and the bigger corrections, And then at some point, I call it the POR, point of recognition, where they realize, rut-row, something's different. I've been buying the dip. It worked so well for so long. It's not working anymore. I keep getting underwater, and they start capitulating. And you've also blown out all the shorts when you get that level, to those levels. As I mentioned, I believe I showed you recently, I have short interest on a lot of the market-leading stocks in the indexes at or even at or near 52-week lows. I don't even almost have to look at it. You can see when you have a rally like that, you can just, and you can look at the price action in stocks. I can read the charts and tell you when shorts are being blown out and covering and capitulating and giving up. Just like longs capitulate and give up at the end of bear markets and big corrections. It's the same thing in reverse. All righty, let's jump back down. There's the SPY daily right there. You're bearish engulfing. And then let's go down to the 60-minute chart. That was your last update. So we hit, this was, remember, support. I posted in the comment section below Friday's post that we were at support where a reaction was likely. We got a reaction, gave you the gap bounce targets right there. Almost a perfect hit, a backfill of SPY on the gap. So that's done. So you've had in the last week, on Thursday, you had the objective short entries at the bearish engulfing candles. At the end of the week, once the trend lines were clearly taken out, and once the weekly bearish engulfings were finalized, and then this was your next objective short entry yesterday on the gap backfills. And stops are going to be commensurate to your price targets, your entry point. Everyone's different, but the next sell signals are going to come. Look, we've already taken this level out. We already formed the gap. We went back and we've already backfilled it. Gaps quite often are backfilled when they exist, and it's better that way. You don't always have to have them backfilled, but it leaves no unfinished business. So it's nice to see when you have a gap near a top, you backfill it and check mark in case we do move lower, that the market doesn't want to go back from a lower level and backfill it. Again, there are no guarantees. That's just something I like to see, the fact there's no unfinished business now that that gap's been backfilled. However, we're still spitting distance between the all-time highs, so it's not an all-in aggressive short moment. When are your next objective short entries? Or if you are a bull, and there are some here on the site and quite elsewhere, the same levels that I give you as support levels that I'm waiting to see break. This is a big one. We hit that level. That's about 619.66. It's the same one I gave to you that on Friday on the futures on ES. The comparable levels. I don't have my ES chart up. Where is it? Got it here somewhere. Bear with me. Here we go. ES, S&P 500 futures, right there. That was where the bounce was likely. We went up, backfilled the gap. And so now that level, if I thought it was support on Friday and said the odds favor reaction, and we had a reaction, it's even better support now. What I mean by that, what was defined as support by all these reactions here. Now that we had a very distinct, clear reaction, that level becomes obvious to more eyes. More people see it. And now it's that's where you're going to have more stops on longs and more short sellers that are likely to jump in if taken out. That's how, in my opinion, technical analysis works. Again, the more apparent or obvious a trend line is, or a price support level, or a big gap, the more likely traders are to trade around it and act on it. So simple stuff, right? Nothing's 100%, but that's how it works. So we've already taken, we already moved through the gap, so I'm not putting too much stock into this level right now because the gap has been backfilled. So that's kind of crossed off or check marked on my list. Got the gap backfill, objective re-entry at a better price for shorting, or new entry, re-entry if you covered there, game of bounce, or new entry if you, for whatever reason, didn't want to short last week on the bearish engulfings, but you do now. Or again, if you are long, you bought that, and now if you get another pullback, the fact that 619.66, we've already had the reaction, the expected reaction on the initial tag, it increases the odds that we're going to go down through it with little, if any, reaction. So what I mean by that, it doesn't mean we can't bounce there. If it does, look, it's still support. And in fact, as I just said, it's even better support now than it was when we got there. And I highlighted on Friday because the fact that we had that clean reaction. So again, it's now better defined. So there's a level for bulls to buy or bears to short or increase short exposure if and when taken out. That's it. It's simple. And then you can see the next levels there, 610.55, 603. Let's go to QQQ. I've always said this before. When trading the markets, there are points in time why I might favor ES, the S&P 500 futures, or SPY, mainly if I think the financials are in trouble and going to go down hard, and they have broken down. I'll try to get to those charts in a second. However, you typically just get more bang for your buck on QQQ because it's more concentrated. It has the same top holdings, the Mag 8 stocks that the S&P does, but it's in a much more concentrated weighting due to the market cap weighting and the fact that QQQ is a very tech-heavy index. The S&P 500 is tech-heavy. It's by far the largest sector, even double the next. There's 11 sectors in the S&P. Tech is like 25%. I think healthcare, the next one, or financials is roughly half that. Now, on the NASDAQ, it's about 50% tech. My point is, you're either going to be right or wrong on your market calls. You might as well get paid for it. So that's why I tend to favor QQQ. All right. And you can also watch those FANGs, those Mag 8s, whatever you want to call them. And then if collectively they all break, or majority of those break support or break above resistance at the same time, that helps to confirm buy and sell signals. All right, so there's your levels. Same level right there. That's where we bounced Friday. You can see a couple reactions, very well defined. Look at this volume and price histogram. I think you can see it in the video. I'm going to highlight it, make it a little brighter just in case you can't. These I like to leave up on my chart. It tells you, it has the volume taken place at each price. Down below, if you see these little white bars down here, that's volume each day. That's the volume, or on each candlestick. This is a 60-minute chart. Volume at price tells me that the majority of traders bought up here in this box that I just made, and there's a big old thin zone. A thin zone is comparable to a gap. If you had gapped up right here, you would have you wouldn't have any volume at price histogram bars. So it's very similar in nature. It means we just went through that level. There was a breakout there, we moved fast, and what happens, just like gaps, when thin zones are entered, they tend to get backfilled pretty quick. And once entered, you usually, just like a gap, you usually are going to backfill it. So, that's what I try to do here, is not just show you where, things are probably headed, but how they're going to get there if it does happen. Now, with that being said, and I say this often, support is support until unless broken. Let me repeat that. Support is support until unless broken. So, guess what, guys? If we don't take this level out, we're not going to go here to my next, 60-minute target. And if we don't take that level out and continue on, we're not going to go to those longer-term swing and trend targets that I've given you now for quite a while on the weekly chart. So let me put these back down. I just don't like too busy of a chart, too much noise. So that's it. So check the short entry. It'll help to see that level taken out. It's still support. We've gone through it a couple times, but it's still support. That will increase the odds we're going to go down here. So what I'm giving you are the support levels that any or all of which will trigger objective short entries. And likewise, if you are bullish, these are levels you might want to buy if you think the market's going to new highs, if you think it's going to take out the recent bearish engulfings. All right, the other sector that I've been highlighting recently, and even gave you some new price targets on this most recent divergent high, SOX, Philex Semiconductor Sector ETF. And my last updates, I told you we had support here called an S1 zone, so we need to clearly take that out. We had a one-day punch down through, back tested it, and now rejected again. You can see we're below there. So that is, my friends, what I call a check mark to make an add-on addition. Remember, we put in these divergent high, pretty much a double top. We broke down from the bearish rising wedge. We moved sideways a little. We're moving lower, and we're coming up on that first target. These are your additional targets down here, T6. And again, the way it works is you're going to have to take out T1 to open the door to T2. T2 is where we're likely going to have, if we get there, a tradable reaction. Why? Because that is both price support, as defined by these levels here, what I see on the chart, but you also have, you also have the 200-day moving averages. Let me show you that right there. And the 200 days tend to define bull and bear trends. When the semis, we traded on them for months there, traded around the 200s, but when we clearly see that big red candle, that's when it clearly finally gave up the ghost, where traders realized the semis couldn't get through the 200s after struggling for months. And then you had all this. And then here you tested them again, a back test, and then boom, you finally broke out. So this will be the first test. of the 200. So again, that's if we get there, and if not, we're above the 200s. If you are bullish semis, you can buy at any of these support levels. These price targets I gave you, including the 200s, are support levels. So that's your entry points if you think we're going a lot higher. SMCI, the what I call the Robin of the Batman and Robin, with NVIDIA being Batman. This is his little sidekick. SMCI taking it on the chin today, down 20%. You can see here, I threw it out as a trade idea back here, and I gave you a relatively tight stop based on some of the earlier targets of a daily close above 57.50. And what happened is it came up on earnings. When right before earnings, typically now I don't have this one. I wish I did go into the day short. I wish I could tell you I had a big short position, but I just haven't been out. I've been mostly kind of focused on the markets lately and some other things, and mostly disengaged. There's just not a lot out there, as I told you recently. It's getting me excited on the charts. I wanted to see how last week, how the markets fared through the peak earnings season, as well as everything that we had, the economic numbers and all that. Job numbers. I'm going to get to that in a second. Somebody made a comment about, don't criticize Trump. I'll get to that in 1 second. But there's the targets, and still very much in play if you held that one. And what happened is you had this divergent high, negative divergence. You had this uptrend line in one fell swoop. We took that out today. This is where we're trading if you can't see it in the chart. I know it's a very busy chart coming up on that first target. And we also failed the breakout. Remember, we had this big symmetrical triangle pattern, well-defined downtrend line, well-defined because you had a lot of reactions, 2, 3, 4, 5, breakout, and now we failed. We're back into it. Be even better to see it take out the bottom of it, which is going to coincide with T2 or T3. So we'll see. This one, you can't write it off yet because you're still above that uptrend line, but just wanted to point that out. And also, again, I started out by showing you SOXX and how that one looks. Let me rifle through the sectors of the S&P 500 really quickly, kind of give you a bigger picture view here. XLK, tech sector, divergent high, bearish engulfing candle. Remember, XLK is almost going to mirror QQQ perfectly because, as I said, QQQ is an extremely tech-heavy index, and so there was your previous highs. That was a gap away breakout. Very, very significant level. I should color code that. Whatever, we'll pick a crazy color. Let's make it this little pink color here, magenta, whatever we call that. That's a big one because that was the previous highs right there. And you can see we pushed against it in the breakout there. This is also a long-term uptrend line I have that was broken here, briefly recovered. So those are your levels to watch on XLK. Now, what I'm doing really is showing you the weighting. What I tell you a minute ago, 25, I was wrong. Last time I checked back in September, it was a almost 33% weighting. So again, there's 11 sectors in the S&P 500, but this top sector makes up a third of the return. So you don't even have to worry about what REITs and utilities are doing and basic materials. They're the bottom 3 sectors. They can be on fire. They can go up 300% in a year. They're not going to move the needle on the S&P 500. It's all about tech. Then financials, second largest, last time I checked, about 12.5%. So you can see us distant second, but still a significant sector. Kind of gives you a health of the economy. This is it has this pattern, just like the stock market. It's very predictable of making marginal new highs, breaking out the new highs. The media cheers it, and then it fails. Shortly after the new highs, that one was a bigger drop. And this is a marginal new high. And the reason they're failing is because the technical posture, the divergences, negative divergences have been building, get bigger and bigger and bigger. And when you see multi-month divergences like that, you want to go out to your weekly chart, and it kind of paints the bigger picture on how things look. So this is XLF financials out on the weekly chart. You can look at it this one. Yeah, this line. This one needs to be moved. That's not accurate. This should be like this right here. This should be white. I haven't touched this weekly chart in a while. That's why I'm doing this right now. And so here's how I see it. You have the negative divergence on the RSI from that point, but on the PPO from this point here, that was the last reaction high there. So this is really our divergent high. It almost mirrors that line, both in scope and duration, or slope and scope, meaning scope how long it is from end to end, and the slope is the angle of it. It perfectly mirrors this trend line here. Again, this is technical analysis. There's nothing 100% about it. The whole premise of technical analysis is recognizing, studying historic chart patterns and then identifying and recognizing similar technicals at this point in time in the market to predict where things are going to go. That's how we look at, past performance doesn't guarantee future results, blah, blah, blah. But you take enough bullish falling wedge breakouts, head and shoulder breakdowns, cup and handles, and these patterns that we have are candlestick patterns. And more often than not, which is far from always, but more often than not, they're going to play out as they have or similar to they have in the past. And you can get really technical on it, no pun intended, and you can actually look at the measured targets for each of these patterns and kind of predict how far a move's going to go. All I can tell you definitively is the last time we had negative divergence on both the PPO and RSI, and almost identical, was right here. And back then, markets were cheering the new highs in the financials, but they turned around from that point. Was it a good time to buy? No, it was a great time to sell and then go short, and they dropped 30%. And that drop didn't end until you put in a divergent low, and then that's where this rally began. So that's it, guys. There was a divergent high there. It was COVID. Again, I've talked about this many times. COVID might go on the history books as a black swan event, but it was certainly priced in. A correction or bear market was certainly priced into the markets based on the technicals at the time. That was just the catalyst. And because it was a unique catalyst, it happened very fast. 36% drop in the S&P. I mean, you blinked, you missed it, but it was there, and that's pretty big. So, all right, let's get to the rest. I won't cover all sectors, just kind of give you an idea. Healthcare has been sucking wind. By the way, we had that Novo Nordisk report today that I told you. Wanted to see how the market held up. And so far, the market's, we have the sell signals I just mentioned, but it's not melting down. I'm going to throw that, I'll highlight that trade idea again for you here. But this is XLY, the fourth largest sector. As you can see, this is my primary, most significant uptrend line. And I have this secondary trend line here that came into play. We had one that was COVID right there. We snapped back above it. We respected it. We broke down. And then we hit the secondary trend line, and we've been in this price channel since right here, right? So big divergence, at least RSI divergence right there. And actually, we have divergence all the way back here on the PPO. We had a divergent high there. And that's the trend line that we need to break. But let me go to that one before I forget it. Let me show you Novo. They reported today. This is my weekly chart. And you can see there's even a reaction right here about where we're at right now. It's more of a support zone that runs from about 47 and change down to about 45 and change right there, if you count that reaction low. Very oversold. The stock's down almost 70% off the divergent high. This one earlier this year, late last year, had the distinct title of being the largest publicly traded company in all of Europe. And so, either way, all I can tell you is we have positive divergences at support in this stock. Certainly had their problems. New CEO incoming this week, and most likely going to, they're already going to, they announced some expense cuts coming up and other things. But how much of that's been priced in? Either way, take it, leave it. These are just longer term targets on the weekly. Daily, I'll have to sharpen my pencil. If you're interested, let me know, and I'll give you. First target on the daily would be about here, about 56 and change. If you're just looking for a bounce trade, that'd be 25%. And then again, I'll have to sharpen my pencil and give you additional targets if you're interested. Yeah, it just makes me think about Lulu, another beatdown, former crowd favorite. Still has that big divergent low. Remember, we already hit our first target there, had a reaction. Put in a marginal new and still divergent low. So this one still looks good. I don't know if they've got earnings coming up or not. When was last earnings was right here. I do this sometimes. You can pull it on earnings.com. You have that link on the website on the right side of the chart, but I'd usually just put a line between the two. That gives me distance, the quarter. and that one's a little farther away. Yeah, we're coming up soon. Looks like coming up soon for earnings. Oh, I have it right here, September 4th. So we've got about another month. My bad. Okay, and here's yesterday's comments from the last post, or was it the day before? Yesterday, the market was just flattish, and there just wasn't a lot to report. Um, Even right now, like I said, we backfilled the gaps. We're just kind of moving sideways today. Doesn't look like there's any resistance levels on the gap on QQQ, new all-time highs. No, well, no, there's not really, there's not much. There's some minor resistance overhead, but not much. My reply was, um, remember at the time QQQ and SPY were back testing, they were at the top of those gaps, providing that objective short entry. More so, both are still very much below the recently broken uptrend lines and tops of last week's bearish engulfing candles, which were and still are the primary reasons to be short at this time. In other words, no change in the technical posture outlook of the market, as I covered before. GDX flying. I'll get to that in a second. I don't want to get too sidetracked here. I might have to do gold separate, but yeah, I'll get to the dollar, GDX, and gold next. Is ACN a buy here? 240s, Alan asked. Yeah, I think ACN looks great. ACN offers an objective long entry here. Let me pull the live chart. That's the chart I posted yesterday. ACN is a censure. And what you have here on the weekly, no, I'll go back to that daily chart. So what you have on ACN is nice support. This was, as you can see here, let me scroll back even farther. In every single instance, this is 2021, the beginning of 2021, right here. Every single 1, 2, 3, 4 in previous instances, that has contained all pullbacks in the stock. In no way, shape, or form does that guarantee it will contain this, but that is technical analysis. The odds favor that is a well-defined support level, so well-defined a blind man could see it, and so it is objective. And it doesn't mean the trade's guaranteed to play out. And as I said in that comment section, you want to give it a little room. It's so obvious, it wouldn't surprise me in the least to see the powers that be, the nefarious forces, take it down to blow out stops. So you could give it a little bit of room if you want. If we do, whether we bounce right off it or have a marginal new low, again, I try to put my stops just out of reach of where I think the cluster of stops are going to be. That's what the hedge funds and the quants and all that, they buy that data. If you ever wonder why your Schwab and Fidelity, all these companies will, even Interactive Brokers has free trades, commission-free trades. They're selling your order flow. That's where they're making money. Now, I pay for commissions. I have an option, my main broker, Interactive Brokers. I pay the commissions where they're not selling my order flows. I hide my stop losses. That's another option I have. They're hidden. They don't go to the exchange until the stop price is reached, so they can't go out and get it, especially on low volume securities I'm trading. And it is vastly, since I've been doing that for years, if not decades now, minimized waking up to see that you were filled at the low of the day on a stop loss order. Anywho, that's it. So take it or leave it. There's your targets, potential targets. To get these higher, I would only look for this point in time, maybe these first two at most. That would be bounce back to 276 or so. And that's if the market holds up. If the market craps out, it's hard to see this one going up much more than that, but that's a 15% bounce there. And hey, if the market holds up, then this one looks good. As I've told you recently, these are the type of stocks I'm more comfortable with. As I said, I wouldn't buy NVIDIA or SMCI or any of those with your money. We're in a bubble. I have no doubt about that. Every sign and trait and signature, I've read books on bubbles. It's what it is. But again, these bubbles, just like 1999, can go a lot further and farther than most people think. So just because you recognize you're in a bubble, don't have to short it. Anywho, all right, let's get off that. That's take it or leave it. There's another trade idea for you. Someone made money trading off the gap. Good, congrats there. Corn and wheat. Did I reply to that one? They're just can't get started. I'll do the grains in another update. There's too many of them. Let's see here. Not sure if you heard. I didn't see this comment. Let me see here. Wheat futures about close to the bottom. Remember, there's still long-term support, very long-term support. That's what but they've been testing that long-term support, that uptrend line for almost a year now. Not sure if you heard, but no tourists in Vegas trending. People are posting videos, empty streets. The market already knows, or I think the market already knows that's what MGM, Caesar, Win, either just had divergent highs. All right, let's take a look at these just so I can answer that now. Win. Yeah, there's some divergence. I always say divergence in itself isn't a reason to buy or sell if it's bullish or bearish divergence. This one, I'd want to put an uptrend line right there. And this looks like a regular EKG, kind of like almost like the airline stocks that go nowhere over years. They trade up and down and up and down. They're great trading vehicles. They're horrible investments. Remember, we already milked one of the casinos. We did CHDN. It's not a casino, but Churchill's down. This is where they do the Kentucky Derby. This is an example. A lot of our trade ideas, a lot of the trade ideas I share, the reason final targets are final targets, usually where the end of the trend is. And now this one's pulled back to support, but we already did it. We milked this thing. We bought the lows, we sold the high. Get in, get out, move on to the next one. Again, it's just in that same gambling group as Win. We have LVS. I already had that one marked up. Trend line right there. A little bit of divergence. So yeah, they're looking like they're getting ready to break down. It's also some resistance around. I'm going to move that line here. It's hitting a resistance zone. So I wouldn't... yeah, these look like they're ready to roll over. I don't have any active sell signals. I can't make a case to short at this moment. Not a strong case. I would rather be short than long because I think they're at the end of the run. Well, what's the other one? I covered MGM. Did I do that one yet? They're just not my kind of charts. I'm not seeing anything that stands out. There's a ETF. If you want to keep it simple and you recognize right now that we're still in earnings season, and you don't want to get clocked on just shorting or going long the wrong one at the wrong time, BJK. It's the Van Ector's gaming ETF. It has all these guys in there. And you can see there, again, they've been just dead money trades bouncing around for the last few years. And there's an uptrend line, which all those other stocks had. When that's broken, it'll probably bring you back down into the trading range. And based on my outlook for the market, and what you just said, fundamentally, the streets are empty. I know that. And this kind of segues into someone maybe I'm a little harsh with my words on Trump. I want to just say this. Look, I've kept, if anyone that's followed me for any period of time on this site knows that for many years, you didn't hear a peep out. I didn't comment on the existing regime in Washington. I try to keep that stuff off the site. And I ask you to as well. Keep it off the site unless anything going on in DC has an impact or may have an impact on the markets. And in this case, at no point in time can I think of a president that moves the markets more than Trump. So yes, Trump is more relevant than any president in my lifetime or in anybody listening to my voice lifetime. There's never been a president that's been addicted to tweeting and firing off, has his own social media company, his own crypto companies, and almost enjoys moving the markets with his words. Also, and just so you know, so if you think, I personally think the man's a buffoon. However, if you want to know this, I wouldn't have voted for Harris or Biden if you put a gun to my head. On balance, I believe in more in line with Trump's politics, but there's just a lot I can sit here and criticize a guy all day long. Now, so the criticism I most recently had is firing the head of the BLS. And I can just say this, and you know what? This guy says it much better than me. This is once in a while I'll check. This guy writes good fundamental stuff on the market. Mike Shedlock, I think is his name. Mishtalk is his site. He talked about did Trump fire the BLS head for cause, being the messenger, or something else. He goes on to mention and think about it here that you can read Trump's reaction to it, and then. So here's pretty much in a nutshell. Somehow, with all this rigging going on for many, many months, thousands of BLS personnel collecting data, every one of them's on this scam. They take orders from the man at the top, and 100% of them are Biden loyalists. No. What he went on to say is The big revision down just came from the 2 previous months when Trump was in office. So by that logic, so those numbers were okay. The fact the job market was overstated, it makes absolutely no sense. If those revisions were from numbers when Biden was in office or Kamala was running for president, that would make sense. So the entire logic doesn't make sense here. In other words, the previous two numbers were overinflated. That made Trump look good. This is just a revision to numbers that happened under his watch. So the logic behind there is so flawed. That's why I'm sorry. And then you get on the thing about Powell. Don't get me started. Read up on it. If anybody out there thinks that it's not insane that the incumbent president is extremely vocal and critical in trying to strong arm and pressure the Fed chairman, whether the Fed's to the degree of politicism or politics in the Fed, they're supposed to be apolitical, and Powell's done a pretty good job of resisting Trump. So maybe there's whatever. Let's not debate the fine details of it, but for the most part, it's an apolitical entity, and it should remain that way. Here's my view, guys, and this is why I'm very critical of Trump trying to, get in here and put in minions, puppets, with his, hand up there like Geppetto, and running the BLS. These are most what separates the U.S. from China. Our stock market is infinitely larger than them. They have a lot more people. It's a much more populous country. But one reason our stock market for in a day has been the go-to gold standard and trusted is things like that we have independent government agencies, apolitical, publishing data. You get Trump's minions in there, and then again, the next regime, let's say it's a Democratic president, and then he fires all the Republican people running these government agencies, BLS and NBER, and then the Fed chief. And then it will controls what interest rates are and what the economic numbers are. We're China. That's why people don't trust the Chinese government. It's a communist, basically almost a dictator regime, and the numbers have always been skeptical. So there's, as you can hear it in my voice, I think it's insane. As do other people much smarter than me when they talk about Trump wanting to fire Powell and put in a minion in his place, and fire the BLS head and put in a minion there, and so forth and so on. So again, okay, I'll try to watch my rhetoric, and I just wanted to say this is where, and you can read again. There's a lot of articles and opinions out on this recently, but to me, it's beyond dangerous and long term. Very bad for the U.S. financial markets and our country as a whole if that were to happen. So, all right, let's get away from there and go to the next. And any more questions? So, all right, I give you the casinos, BJK, where when they break those trend lines, that'll be the next leg down most likely. You apply marked up charts for RTY and IWM. Sure, I'll be glad to mark those up. Let me cover that too. And I'll get to GDX there, and then we'll wrap this up. All right, so let's cover the charts of IWM. IWM, this is what it looks like on the daily, and I'll post one of these. Let me just borrow that DH right here. So, big stuff. Big tops come from these big divergences that occur on the daily time frame. There was a divergent high, bear market. We went up, made effectively a double top, which was still divergent high, another drop. Small caps have an unusual, I haven't seen an index, go sideways like this for that many years in a long time. So the small caps have gone nowhere. And surprisingly, they've held up because they tend to be more rate sensitive. We've been in a rising rate environment since this period of time. But we're also on the other flip side, we're on a risk on market. There's a dash for trash right now. Where's the trash? Well, say what you want about NVIDIA, but it's not a trash stock. It's got a lot, or Apple, they've got a lot of cash. Those are mega caps. Small caps are your small companies. So when you hear that dash for trash going on, it's a small and micro cap company. So that's kind of the offsetting cross currents right now. Rising interest rates are net bearish for small cap companies because they're more dependent on financing than large caps. But then again, a risk-on speculative market is a net tailwind for them. Technically, so that's fundamentals. We can sit here and talk all day long. I'm going to give you my technical opinion. So we've had this series of uptrend lines, 1, 2, 3. Each of those broken. They almost look, or 4 actually. It's similar to Fibonacci fan lines. I don't know if you ever played around with those. Here, let me find a clean board. I'll put some up here for you real quick and show you, see if they match. These are fib fan lines. Sometimes I'll notice you get a series of trend lines like that. You put the fib fan lines up there, and then that was the first one. So you can see here, we broke the first fib fan line there, had a correction, went up, broke the next one. Well, no, we didn't. We rode on it, broke it there, another correction, and then broke that one. So this one should be the lights out if and when that goes. And that'll also coincide with the 200-day simple and exponential. So that's what that looks like. Now, from the trend lines I had are right here. Most recently, we hit this big, I had it yellow, it's pretty important resistance, and then we took out that trend line. We hit perfectly the other day, the 200-day exponential moving average bounced. Of course, that was the biggest drop in months, so you expect them to come in and buy it there. That's the level that needs to go. When the 200s go, then you're in a downtrend. The 200s on so many sectors and indexes just do a great job, as I'm highlighting here, of defining bull and bear trends. Bullish when you're above them. Once you clearly take them out, bearish. Once you clearly regain them, bullish. So I cannot get too bearish on the smallies until that goes. I'm talking longer term. Near term, the technicals, we just broke down. So while the technical trend and the fact we're above the 200s right now is bullish, the posture, again, I try to get in front of corrections. I'm usually long, covering shorts at the end of sell-offs and going long, but long before the 200s are recovered, just like I'm usually shorting at the top and closing longs long before the 200s are taken out. So in this case, we overshot them. We took them out, and that will be kind of the lights out and open the door to much bigger. I have on the monthly chart, weekly. This is my weekly chart. Divergent high, double top. This whole box here, that's your double top pattern. So a double top, and I encourage you to look these up. When I say these things, don't take anything I say on face value, unless it's something I've made up on my own or discovered. But these are typical patterns. I didn't make up a double top pattern. When you look up how to trade them, you see 2 distinct patterns. You look for the bottom of that range, and that's this purple box here. This says double top measured target, which is simply you take the distance of the range, which is that trend line. I make a duplicate trend line. I add it to the bottom of the range where it breaks out. That would be your double top pattern measured target. Now we're closer to the highs of the double top pattern. And you can even get a triple top. That would be the same thing. If this thing goes on for another year, gets rejected there, then you have a triple top. It's the same measured target. So now when you look at my weekly chart here, we took out, put a big bearish candle there after that breakdown. So where I think the smallies are going down to, ultimately below, and down here to my minimum long-term target. Now I created this target back in, when was that? April. And I would have shared this double top pattern with you then. Remember, this is all part of, and I get this criticism on the site. I've been longer-term bearish for the last couple of years, although swing and trend trading. Again, haven't missed a low, covered those lows, went long, reversed. So it's kind of been trying to, how are we going to get from point A, which was this top that I called on the markets, on the S&P, QQQ, everything back then. We had multiple targets. You can see these targets. T3, I think you can see it. I created that back in early 2022, right? This is when we peaked here. So we went on, hit my first, second, and third target. That should be highlighting green. Hit. I think you can see it. If you can't, that's what says T3. And then we had a divergent low. And this is where we were covering things back here. And we put in another divergent low right there, an even larger. You can see the positive divergence. As I've told you lately, a lot of my lines have disappeared on the PPO. That was a divergent low. We went back up and then put in this double top and still divergent high. And so that's it. Now T4 was and still is my next target. But again, everything's playing out very slow. Most people don't have patience. And again, I don't sit here. I'm not holding a short from back here anymore. I've been long, short so many times as a active swing and trend trader. But the bigger picture, this is what I see. You can see my chart here on IWM. This is your primary secular bull market uptrend line. It comes off the 2009 lows. That's when the last, what I call real bear market ended. The financial crisis, '07 highs to March '09 lows. That comes in there. If that double top pattern is taken out, the bottom of it, the base, which triggers a major sell signal for the reasons I just stated. It's the breakdown of the pattern. That's where you would short pattern. You're also going to have taken out that long-term secular bull market uptrend line. So, and I say that for those of you that think my targets are too aggressive, what calling for all said and done, I got to come in a little higher than the top, or I'm going to move my drawings. My minimum target, so I'll stop a little shy, is a 55% drop in the small caps, with a maximum target zone that ranges from 63 to whatever. And so there's my thoughts on IWM. You go shorter term. Somebody asked for RTY. The same person asked for RTY. Back here, this is the daily chart. I gave you a couple targets. I highlighted that the smallies had, after putting in this divergent high, this is the daily chart of RTY, small cap futures. We took out this trend line, which was bullish, and back tested it. That was a catalyst for this rally. So what we have here is that series of uptrend lines like I just showed you on IWM. This last one broken. We had a divergent high, and back here somewhere I gave you two stops, a more liberal stop and a tighter stop when it was back here somewhere. So far we've reversed a little shy of that other stop. Look, this is really good support, guys. We just hit it. Remember, I just showed you on IWM we also hit the 200-day moving average at the recent low. This to me is a very, very big level. This is resistance. So we broke down from this wedge. We put in a divergent high. Nothing goes straight down, especially when the large caps are holding up. Smallies corrected. We're right back to resistance. I believe it's an objective short here. And once this level goes here, that's a lights out level, 2147-ish. You can see I could add a level right here. We're going to hiccup around 20, little shy of 2100. But this is my next long-term target right there, 2015, and then ultimately that will likely go, and then we'll go a lot lower. So that's my target. Now, if we continue to rise, this is the next big resistance on RTY, about 2376. So maybe we hold that level, rally on up. If so, it's going to look like this. I'm going to tell you right now, the divergence is just going to grow a little larger, but will still be intact if it happens soon, right? But that's not my preferred scenario. I'm just highlighting what'll happen if the smallies do hold up here. It's most likely going to take an abatement in interest rates, long-term rates, the 10-year bond, 30-year bond, they're probably going to have to come down. And remember, I talked about that before, how the last Fed cutting cycle did the exact opposite as anticipated. It made long-term rates go up instead of down. So that's where the other criticism I have of Trump is, as if nobody just showed him that chart that I've told you many times before, and yet he's pressuring Powell to cut interest rates to help homeowners and get into mortgages and businesses. And this is where the Fed lost control of the rates, because the market's more worried now of inflation heating back up, and or, which is both, other countries and institutions, U.S.-based institutions, hedge funds, pension funds, not buying our long-term debt because of our deficits continuing to swell. So that's why, unlike in the past, where Fed cut 50 basis points and 25, instead of rates, long-term rates going down, long-term rates did nothing but go up, okay? And so here's Trump clamoring that it's going to help the economy if the Fed cuts rates. Well, maybe it'll return back to the historic pattern. But lately, the market's been saying no. It's more concerned about the ballooning deficits the U.S. has and how it's going to finance its debt going forward. And so by that logic, you probably want rate hikes to see long-term bonds come down. I don't know. Long video. Let's get to gold, GDX real quick, wrap it up. Gold's gone nowhere for a while, so I haven't been doing a lot of updates. If you zoom in nice and tight, here, let me show you GC gold futures. Let's do that. Let's go here. This is the 120-minute chart, 6 months price history, 2-hour candlesticks, breakdown back testing right now. But the bigger picture is this sloppy EKG. Gold has gone nowhere again for months, and my long-term outlook has not changed, or intermediate term more so, and that is UUP, called a bottom in the dollar here based on this trading range. I've covered this ad nauseum recently. Big bullish falling wedge, positive divergence, breakout. We just hit my first target, pulled back as expected, and so if and when we take T1 out, this is where I believe the market, including gold, will get the memo that the dollar is rising, and I've highlighted quite a bit in recent weeks and months the inverse correlation where a falling dollar is bullish for gold, gold tends to go up, and a rising dollar is bearish. So we just need to see. Right now we're still off those lows. That yellow line was just the measured target for the bullish falling wedge, which was effectively hit, and we need to power on up. Now, all I can tell you is that's still my, I gave you 2 targets. If I didn't think that one would be hit, I wouldn't have given it to you as a target. So I'm still going off that's the most likely scenario. By every tech or the simple definition of an uptrend in technical analysis is a security making higher highs and higher lows. Now, this is what we call an intermediate term downtrend with a near term uptrend. So the case can be made, as I made before, of a trend change in anticipation before it even happened by, going along or highlighting the dollar likely to reverse here at long-term support at the lows, and then when the bullish falling wedge broke out. So that's it. My outlook hasn't changed. GDX is a risk-on asset now. A lot of folks are buying the miners. It's enjoying that risk-on trade right now. But as I showed you, they're going to have, usually you'll see a reversion to the mean. Some of my favorite trades on GDX are once I've made a strong case that gold has bottomed and has started going up, and I can make a case it's going to continue to go up, yet the miners are still falling or down. And then what happens is they play a game of catch up to gold once the market realizes that the bear market or the correction in gold is over. And so this will be that in reverse. Now, again, I can't make a strong case until I see the dollar break above T1 and gold break down clearly below this trading range. If so, the miners are going to pay you much, much better. They're going to play a game of catch up to the downside. And I've given you targets on them recently. Same story. We had a divergent high right here, only on the RSI, as I pointed out. Now we have divergence on all the indicators. And this is your uptrend line. So this is, I'm just going to give you real quick. Gold's in this, or GDX is in this near term or intermediate term, more powerful uptrend. Remember, we went long off these lows here at the bottom, highlighted that divergent low. It's been a great trading vehicle and a good investment vehicle, over the last year or so. I've been up more just comfort level swing trading. Here's a trading range it needs to break. And so if this breakout fails and then you drop below that trading range and that trend line, that will most likely be the sell signal on the miners that will take them down. This is what it looks like on the weekly chart. You get the divergences building. And again, it's all about this one right here and the US dollar, where gold goes from here. Silver's already broken down. Silver was playing a game of catch up to gold. This is my 2-hour candlestick chart of SLV, silver futures. And you had that divergent high right there, recent breakdown, a little kickback rally. And this level right here, it's a big level, 36.96. When that goes, that should be lights out for silver. Probably take it down to right here. And then the miners will most likely come into pressure because a lot of the miners are also exposed to silver as well. Okay, guys, that's a whole lot of charts. I skipped, yesterday, just kind of didn't see a lot, so saved it all for today. Keep the questions coming. If you see anything you want chart opinions, any existing trade ideas I've thrown out, or anything that you're seeing, you're watching, let me know. But you have my thoughts kind of on bigger picture and some of the sectors I like and on the long or short side right now. This has been Randy Finney with Right Side of the Chart. Have a great day.